Welcome to the CoreLogic RP Data update on housing market conditions for June 2015. Last month we saw the rate of capital gains take a breather, with dwelling values down 0.9% according to the CoreLogic RP Data Hedonic Index. Despite the month-on-month fall, the housing market trend remains very strong in Sydney and Melbourne, while most other cities are experiencing more modest conditions. The weak monthly result can be attributed to several factors. Firstly, the capital gain result for apartments was substantially lower than what was recorded for houses. Unit values were down 2.3% over the month across the combined capitals, compared with a 0.7% fall in house values. This trend can be seen across each of the capital cities. However, it is most pronounced in Australia's two largest cities, in Sydney and Melbourne, where apartment values had shifted 2.8% and 2.5% lower. The slower rate of capital gain in the apartment sector can probably be attributed to the higher supply levels across the multi-unit sector compared with detached housing. Additionally, we're likely seeing some natural correction in the index after dwelling values rose by nearly 4% over the first 4 months of the year. Considering that housing market data flows have mostly remained buoyant during May, it's likely we'll see the index move back into positive territory when the June figures are released next month. Auction clearance rates have maintained their readings at close to record high levels. Advertised property listings remain lower than a year ago, and homes continue to sell rapidly in Sydney and Melbourne. Once again, the strong data flows relate mainly to the Sydney and Melbourne markets, while most other capital cities are generally showing softer indicators. Looking at the level of capital gains across the past 12 months, dwelling values have moved 9% higher across our combined capitals index, taking values 24.2% higher across the current growth cycle, which incidentally marks its third-year anniversary this month. The headline growth figures sound very high. However, the growth in dwelling values over the past year ranges from a 15% gain in Sydney all the way through to a 2% fall in Darwin dwelling values. In fact, outside of Sydney and Melbourne, the next best performing capital city over the past year has been Adelaide, where values are 3.4% higher. Moving on to rental markets, the rate of growth in weekly rents has fallen to its lowest annual rate on record at 1.5% growth over the past 12 months. Hobart's recording the fastest increases in weekly rents at 3.5% per annum, while rents have fallen in Darwin, Perth and also in Canberra over the past year. The soft rental market conditions are seeing rental yields trending lower each month, with a typical capital city dwelling now showing a gross rental yield of 3.7%, which is 40 basis points lower than a year ago. The lowest rental yields can be found in Melbourne at 3.3% and Sydney at 3.6% gross, while Darwin and Hobart are showing the highest yields at 5.6% and 5.4% respectively. Let's have a look at the housing market conditions across each of the capital cities. Like most capital cities, Sydney values were down over the month, falling by 0.7%, but remaining 6.2% higher over the first 5 months of the year. The month-on-month fall in Sydney values was heavily influenced by a 2.8% drop in unit values. In fact, the Sydney unit market has seen values rise by just 1.1% over the year to date, compared with a 7.3% rise in house values. The growth trend remains very strong though, with Sydney values 15% higher over the past 12 months. One of the key factors driving the Sydney housing market is the shortage of advertised properties. Compared with a year ago, Sydney is showing 25% fewer property listings, and new listings being added to the market are 14% lower. The lack of choice for buyers means little in the way of negotiating, and homes are selling in less than 30 days on average as buyers compete for the small pool of available stock. Melbourne's housing market is seeing a much different level of capital gain between houses and units. Values slipped lower over the month across both product types. However, over the past 12 months, Melbourne house values are 9.8% higher, compared with a 2.9% rise in unit values. The slower rate of growth in the apartment space is likely due to the high level of new apartment supply entering the inner city precincts of Melbourne. While dwelling values have moved 9% higher over the past 12 months, rental rates have increased by a much lower 2.3%, causing local yields to contract by 30 basis points over the year. Melbourne rental yields remain the lowest of any capital city, with houses returning a gross yield of 3.2%, while apartments are returning a higher 4.3% average gross yield. Housing market conditions in Brisbane have remained sluggish, with values reducing by 0.8% in May and down by 0.5% over the past 3 months. The last year has seen Brisbane home values rise by just 3.1%. The weaker housing market conditions at a time when Sydney and Melbourne values are rising rapidly comes back to the softer economic conditions in Queensland, and a slowdown in population growth. However, with higher rental yields and better housing affordability, we may start to see an improved capital gain result over the year ahead. Gross rental yields in Brisbane are now 4.5% for houses and 5.4% for units, and Sydney house prices are now 80% higher than what Brisbane's are. Adelaide's housing market has taken over from Brisbane as showing the third highest rate of capital gain across Australia's capital cities over the past 12 months. Dwelling values are 3.4% higher over the year, despite a 0.2% slip in values over the month of May. The gains are almost entirely due to growth in the detached housing space, with Adelaide house values up 3.5% over the past year, compared with a 1.8% rise in unit values. Rents aren't showing a great deal of growth either, with weekly rents rising 0.4% over the past year. However, gross rental yields remain above the capital city average at 4.2% for houses and 4.9% for units gross. The Perth housing market has continued its softening trend, with values down 0.5% over the month of May and dwelling values rising by just 0.7% over the past 12 months. The weaker economic conditions, coupled with a slowdown in population growth and a ramp up in dwelling supply, has dampened the levels of capital gain across the Perth market. Rents are tracing backwards by 4.5% over the past year, which is reducing rental yields as well. In a further sign of falling demand, year-on-year transaction volumes across Perth are now 11.8% lower. The recovery that was taking shape across the Hobart housing market through most of 2014 has lost some of its steam, with dwelling values down 0.9% over the past 3 months and 1% lower over the past year. Importantly, while values have once again slumped across Australia's most affordable capital city, rents are now rising at the fastest pace of any capital at 3.5% per annum. The rise in rents and the slight fall in dwelling values means that Hobart yields are tracking higher and are now the second highest of any capital city after Darwin, with Hobart houses recording a 5.4% gross yield on average and units returning a 5.7% gross yield. Dwelling values in Darwin showed a surprising rise in May, with local values up 0.6% over the month. However, in trend terms, the Darwin market is rapidly losing steam and is now the weakest performing capital city over the past 12 months, with values down 2%. The correction in values has been most apparent in the apartment sector, where values are down a larger 4% over the past 12 months. As values fall, so too are rental rates, with a typical Darwin rental now 5.5% cheaper over the past year. The Canberra housing market saw dwelling values move higher in May, recording a 1.4% rise over the month. The latest data takes the annual change in Canberra dwelling values to 2.4%, which can be attributed to a 2.9% rise in house values, balanced by a 3.9% fall in unit values. Canberra rents are still showing some weakness, however. The rate of decline has improved over recent months, and Canberra rents are now only 0.5% lower over the past year. With interest rates moving even lower in May, we are expecting the correction recorded over the month of May could be short-lived. Values are likely to resume their upwards trend in June, once again driven by Sydney and Melbourne. However, we are expecting the rate of growth could begin to moderate as the banking sector looks to tighten lending for investment purposes, as well as limit the growth in interest-only loans and low deposit loans. With investors now comprising more than half of all new mortgage originations, a tougher lending environment for this segment of the market could dampen demand enough to ease the level of capital gains. Tightening investment lending will impact Sydney more than other markets, with investors now comprising 60% of all new mortgages across the New South Wales market. Other constraints on buyer demand are housing affordability and the low rental yields on offer across the most active housing markets. Sydney's median house price is now $880,000, while the typical house in Melbourne costs a more reasonable but still high $620,000. The high prices are likely to act as another barrier to entry for many buyers. With rental yields for houses now in the low 3% on a gross basis in Sydney and Melbourne, prospective investors might start considering other asset classes or housing markets where rental yields are substantially higher. Thanks for viewing our latest update on housing market conditions across Australia. Of course, you can always find fresh and interesting research on the local housing market at our website and research blog located at www.corelogic.com.au.